Here's something wild. The fastest growing lending category in America is running on uninsured title work. And that's not an accident. It was built that way on purpose. Let me explain. When you take out a home equity loan, a HELOC, the lender usually skips full title insurance. Why? Because the math doesn't work. If you're borrowing $75,000, a full title policy just eats too much of the deal. So instead, lenders rely on something faster and cheaper, a current owner search. Basically, a quick check of the public record. That's become the industry standard for this product. Fine in a small market. But here's where it gets interesting. This market isn't small anymore. Homeowners pulled around $47 billion in equity in just the first quarter of 2026. That's the biggest first quarter since 2021. Second-lien originations, that's the technical term for these home equity loans, are moving at their fastest pace in almost 20 years. And HELOC debt outstanding. It's expected to grow another 9.5% before the year is out. So why now? Simple. Nobody wants to give up a mortgage they locked in at 3%. Rates went up, and homeowners realized refinancing would mean trading a great rate for a much worse one. So instead of refinancing, they're borrowing against the equity they've already built. It's the workaround everyone's using. And all of that growth, it's pouring into the one lending product where a quick public records check is already considered good enough. That's the tension. If these loans close fast, sometimes in days, sometimes in hours. Speed is the whole selling point. But that same title work either has to keep pace with the volume, or it becomes the reason the whole thing breaks down. A system built for a niche product is now carrying the weight of one of the hottest categories in lending. And the real question isn't whether that search is good enough today. It's whether it's still good enough at this scale, at this speed, with this much money moving through it. Worth watching closely.